still believe that there is a recession coming. I still believe that, and by the way, this is probability based, right? If you look at history of the Federal Reserve intervening, they usually are late to the punch, meaning they'll probably keep rates a little too high for too long and will slip into a recession. And we've had one of the biggest expansionary periods, minus the COVID drop, which was very quick, but we've had such an expansion of the money supply that's, again, inflationary. I do think that we're still due for that sort of recession period. And I don't think the Fed is going to be able to drop rates what the market's expecting. We know the market's right now pricing in 6 to 7 rate cuts in 2023. The Fed said 3 rate cuts. So the Fed and the market are way off. And then we got jobs data this morning, the ADP private sector numbers that came in much better than expected. They were stronger, and jobless claims are still around 200,000, which is really very good for the economy. So the jobs market is strong. I don't know where people are expecting these cuts to come from. And then you have to look at inflation, right? Not to get into even a further discussion, but yes, inflation's come down dramatically. I think a lot of that was the supply issues that we were facing kind of during COVID. But now is the hardest battle. Can you get from 3 and change down to 2.5 or 2? That's going to be the hard part. The preliminary indicators are very similar to '07, right? So in '07, the jobs market stayed strong for a long period of time. It was the last domino to fall. What we're seeing right now is we see a consumer that's getting more and more stretched. We see, again, personal debt on credit cards, all-time highs over $1 trillion. We see auto loan defaults starting to uptick more and more. Bankruptcies across the board are at levels we haven't seen in quite a while, going back to, like, I think it's 2012 or so. And so, again, the underlying fundamentals, even the PMI data has been weaker, usually below 50 is contraction. We've been generally seeing that continuing to come out. So all the underlying data to me is insinuating a slowdown in the economy. It's just the jobs market has stayed strong. And again, if the Fed is going to keep rates at their highest levels, and again, granted, you could go back in periods where we had higher interest rates, but the rate at which they ran up was unprecedented, from basically 0 to 5.5%. That would be unprecedented for the Fed to do a soft landing or no landing at all scenario. So my guess is by the second quarter of this year, we start to see the jobs market crack. We'll even see the jobs data tomorrow, the non-farm payrolls. Let's see what it shows us. But when the jobs market goes, and look at this historically, you see a very, very slow tick, and then it falls off a cliff. It's where everyone starts to say, uh-oh, here it comes. I've got to lay off these people. You're seeing the stresses in the business system. I do think it plays out this year. I think we just heard about a few companies just in the last few days laying off 15% of their workforce. We've seen it actually all in 2023, the layoffs continuing. For me, it's probably more in the consumer-led areas. So for instance, Apple, I think Apple is already, you're seeing the downgrades to sell just a few days ago to start the year. We got another downgrade today on Apple. You have declining revenues in Apple, for instance, year over year, declining revenues. They've been artificially inflating their earnings by buying back stock, but that only takes you so far. If the consumer really is getting towards an inflection point, you're going to see these companies that have these kind of outlandish price to earnings ratios, historically, comparatively, those will be the ones that probably take the biggest hits on their stock price. The markets have this dependency on getting positive results. So the market will tend, and this is, when I say the market, I mean overall investors, hedge funds, all the rest of these, they need to see those returns. And so any sort of positive light at the end of the tunnel, they're going to spin into a narrative that is very, very positive. And I think that's what we've seen over the last 12 months, where it went from, oh my goodness, the Fed's hiking and hiking and hiking, and this is going to cause a really catastrophic situation, to now the Fed, we got that little ounce of the Fed pausing, maybe some rate cuts, and they're spinning it to be this miraculous, solution that's going to keep this economy and the stock market running. And the one thing I would say is the market's expecting 6 to 7 rate cuts in 2024. You have to ask yourself, as an investor, as a logical, free-thinking investor, what has to happen to the economy for the Fed to cut 6 or 7 times? And again, those don't mesh, right? So yes, the market wants lower interest rates, but to get that many cuts, the economy would have to fall off a cliff, in my opinion. Again, I don't think I don't know about a cliff dive, but I don't think we're getting 6 to 7 this year. Basically, you saw the Fed minutes yesterday. The markets had another down day yesterday. We're recovering a little bit from some downside today. But I think the markets, when we heard the Fed minutes come out yesterday, they were a little disappointed. They heard, again, 3 rate cuts next year. That's basically what the Fed is choreographing. And that's underneath what the markets are pricing in. So there's this disparity. And we can kind of see that. Like if we bring up the 10-year yield, and I'm going to bring up my chart here in just a second, but if we look at the 10-year yield, the 10-year yield is trading just around that 4% level, right? And so again, we've had had this monster readjustment in expectations from 5% on the 10-year down to as low as 3.75, 3.78. Now we're back just underneath 4%. But if you look at where the Fed funds rate is at around 5.5%, and here the 10 years below 4, that's pricing in just alone there 6 25 basis point rate cuts. I do believe that, again, the market is overshooting to the downside, and we are going to see rates move back up, probably back to around that 4.5%. So this equilibrium where it's right around those 3 to 4 cuts that the Fed is pricing in, that's they're telling us, that's where interest rates probably have to adjust back to over the next couple months. So the gold chart here, we see the gold chart here. We continue to have kind of resistance around 2075. We've pierced it now pretty significantly. We had that one little pop up. Notice again that we really haven't closed above this level on a daily basis. So that's what you're looking for as a breakout tactic here. Now, one of the things that I do see, and I'll give you a price target here, and I'll show you exactly how I arrive at it, is that you do have an inverse head and shoulder pattern. And an inverse head and shoulder pattern is a bullish pattern on this chart. Again, you look at a bunch of these patterns, they tend to break out, and we can actually calculate out our target. So what we'll do here first is I want to draw on that head and shoulder so everyone can see. And again, simply put, there's your left shoulder, your head here, right up to that line. Here's your right shoulder, right? And so the idea is that if we break above this, this plays out. Now you might say, okay, well, how do we arrive at the target? And this is a great tactic for everyone to use at home when you find one of these patterns. Take the lowest point of the head and then draw a line straight up to the neckline. This is called the neckline, essentially upside down neckline of the human being, right? And you see it's about a $450 move. And so the idea is that you should do, once you break out, that $450 move should be replicated to the upside, which takes us to about $2,500 and a quarter. So $2,525 as a target price on gold. And that, again, whether it's hit this year or early next, I don't know. But in general, you can see that each cycle, so each cycle pattern lasts about a year, right? About a year is each part. So it implies that in approximately a year, we should be around $2,500, which again would be a tremendous return for gold. We haven't seen these type of returns in a year period in gold in a very, very long time. And one thing I just want to show you guys, and this is just a cool thing going to oil, I want to just prove to you guys how this works, this measured move tactic. And so here we have same thing on oil, right? So shoulder, this is actually the opposite. This would be called a head and shoulder pattern, which is a bearish pattern. So inverse is a bullish one, a regular one is bearish. And if we look at the neckline and we take the highest point of the head down to that, it was a $14 drop. And if we look at where we broke down and we do $14, look at where oil bottomed out before starting to catch a bid. It completed that target and is now starting to move up and chop sideways more. So again, just to show people out there how this is actually applicable and how it actually does play out. It's not always going to be 100% accurate, but it gives me a good basis to make these predictions on gold, for instance, should it break above this current level. The dollar, we did see it come, quite a drop from the highs, right? We were at 107 over here, and obviously the previous year in 2022 we topped out at 114, and so it looks to me like we're now making lower highs. And you can see again, we came down here to this low trend line, which is a connector from this pivot to this pivot, and right there gave us the low on the dollar. We then retraced up to this point, but at this point I'm really thinking that the dollar is going to be making lower lows and lower highs. So you're going to get bounces like we're seeing now. We could even bounce a little bit more, but I do think the dollar continues to kind of inch lower. The big level on the dollar to watch, and I'll give you guys the one to watch here, is this line here at 99 and change, right? So we could see we tested it in 2023 in February, or check that, in July, and that was this pivot. If that breaks, then you have something bigger in store for the US dollar. But right now we're still holding above that major pivot point, and so I would kind of remain negative overall, but expect bounces at key levels. Anytime the dollar moves up, there's always a chance that gold could sell off. But the one thing I would just point out is, especially this latest move up in the dollar seems to be coordinated with a little bit more tensions and escalation in the Middle East. I think people were kind of asleep into the end of the year. And so that's the other caveat to it, is that if the dollar starts to move up, is it because of instability geopolitically or instability overall in economics, where gold actually could be a recipient of money flow as well? And we have seen periods in history where the dollar has gained and gold has also gained. Maybe not as much, but there is that flight to safety possibility. So for me, it's continuing to believe that in almost any scenario, gold does very, very well, right? Economy stays good, it's going to keep inflation elevated. You probably see, again, gold perform relatively well. If things get really catastrophic, people run to gold for safety. Yeah, the dollar, again, could fall in those scenarios, but it really is most scenarios leading to gold going higher.